Is the global minimum tax deal and what will it mean? Economics expect that the deal will encourage multinationals to repatriate capital to their country of headquarters, giving a boost to those economies. A global deal to ensure big companies pay a minimum tax rate of 15% and make it harder for them to avoid taxation has been agreed by 136 countries, the Organization for Economic Cooperation and Development said on Friday. The OECD said four countries Kenya, Nigeria, Pakistan, and Sri Lanka had not yet joined the agreement, but the countries behind the accord together accounted for over 90% of the global economy. Here are the main points of the accord. Why a global minimum tax? With budget strained after the COVID 19 crisis, many governments want more than ever to discourage multinationals from shifting profits and tax revenues to lower tax countries regardless of where their sales are made. Increasingly, income from intangible sources such as drug patents, software, and royalties on intellectual property has migrated to these jurisdictions, allowing companies to avoid paying higher taxes in their traditional home countries. The minimum tax and other provisions aim to put an end to decades of tax competition between governments to attract foreign investment. How would a deal work? The global minimum tax rate would apply to overseas profits of multinational firms with 750 million euros, that is 868 million in sales globally. Governments could still set whatever local corporate tax rate they want, but if companies pay lower rates in a particular country, their home government could top up their taxes to their 15% minimum, eliminating the advantages of shifting profits. A second track of the overall would allow countries where revenues are earned to tax 25% of the largest multinationals' so called excess profit, defined as profits in excess of 10% of revenue. What happens next? Following Friday's agreement on the technical details, the next step is for finance minister from the group of 20 economic powers to formally endorse the deal, paving the way for adoption by G20 leaders at an end October summit. Nonetheless, questions remain about the US position, which hangs in part of a domestic tax reforms the Biden administration wants to push through the US Congress. The agreement calls for countries to bring it into law in 2022 so that it can take effect by 2023, an extremely tight time frame given that previous international tax deals took years to implement. Countries that have in recent years created national digital services taxes will have to repeal them. What will be the economic impact? The OECD, which has steered the negotiation, estimates the minimum tax generates 150 billion in additional global tax revenue annually. Taxing rates on more than 225 billion of profit will be additionally shifted to countries where they are earned from the lower tax countries where they are currently booked. Economists expect that the deal will encourage multinationals to repatriate capital to their country of headquarters, giving a boost to those economies. However, various deductions and exceptions baked into the deal are at the same time designed to limit the impact on low tax countries like Ireland, where many US groups base their European operations. Thank you.